Okay, very good morning. Thursday, the 29th of March. As you can see here, the countdown is on. It is 1 year to the day until Sam North is throwing a big summer party. You're invited. It's Brexit. There you go. You've got to wait not just 365 days, you've got 15 hours, 27 minutes, and now 0 seconds until Sam's buying the beers for everyone. So I need to call them out from time to time. But okay, given that it is a year until Brexit kicks off, I thought what I'd do is just give you a quick update as to the current state of play and a few things that we're looking out for, because there was a really fantastic research document got my hands on last night. I have sent that out to all of you on our amplified distribution list, so do take a read, but I'm going to go through a couple of the highlights, because I think the reason why I particularly like the ING research is because it's just very plain and simple to understand, and it's all done via an infographic format, and Will knows how much I love an infographic, but it just saves considerable time to make what can be quite complex ideas. So a couple of things here to have a look out for. Let's just jump straight down to some of these graphics. This is looking at the UK economic dashboard. This, as you can see, is inflation. Now, the really interesting thing here that a lot of analysts are anticipating now, if you remember, inflation in the UK on a year-on-year basis was tracking at 3% quite consistently for several months. However, the previous CPI data came in at a drop of 2.7% from what was 3%, so a meaningful decrease. Now, most analysts, like ING is saying here, do think that inflation has largely peaked, because prices have more or less adjusted, and therefore the depreciation of the pound, which catapulted cable higher over the period of the last kind of 12 months, has started to fade out of the equation in that respect. And so, much like the Bank of England have been saying, anticipating that inflation will come back to target in the months ahead. So that's the inflation situation. Now, this is obviously a positive situation, because not only is inflation coming down, but wages are going up. And we saw that with that strong response last week with the positive, better than expected UK wage data. So suggestions are now that the income squeeze, which really defined most of 2017 for the UK consumer, may now have passed. But we still expect disposable incomes to remain more or less flat. So it's not like we're getting overtly confident. I think from a confidence point of view, by a lot of economic indicators, Europe is on fire at the moment, whereas the UK is at multi-year lows. So it's not as if consumers are going to go out and start spending tomorrow. But certainly this divergence, i.e. the price of goods going up and wages remaining pretty static, has started to fall away slightly, which is a net positive. And this also then plays into the reasons why, if we scroll down to here, the Bank of England are expected to be able to hike rates. You know, you would be thinking, well, there's political uncertainty, consumers are really feeling the pain of the cost of living is getting more expensive. However, those things I've just discussed would say that that's actually starting to we're moving away from that situation. Not only that, we have, at least for the foreseeable future, some clarity over the Brexit kind of transitional deal being secured, and obviously that's everted the kind of cliff edge scenario. So as per the graphic is showing here, if you're looking at a checklist of things to tick off in order to execute a May interest rate hike from the Bank of England, faster wage growth, check. Stronger global growth, check. Brexit transition period secured, check. The only thing really here yet to be seen, rebalancing growth towards investment and exports. There's still a little bit of uncertainty to invest. Obviously, these things don't happen overnight, and Brexit still is an uncertainty over the next kind of 2-year horizon, or let's say to the end of 2020, when the current transition deal would expire. Now, if you actually look at the chart at the bottom, in 2 years' time now, market overnight index swaps are pricing in 3 interest rate hikes over the next 2 years. So don't forget, the original Bank of England forecast were for just 2 by 2020. So the market has got more hawkish in that respect. The difficulty will be, although a May interest rate hike is very much expected and priced into markets now, it is, can they do a second interest rate hike as soon as 2018? And what this graphic is essentially suggesting is that the complexity of Brexit talks may well provide a barrier for the Bank of England to take further action so quickly. Because if you remember, trying to formalise the details on things like the Irish border issue, this does need to happen at this 18th, 19th of October European Council summit. That is the unofficial kind of deadline, because then it needs to be ratified with a kind of 6-month layover period by all of the European 27 national governments or parliaments. So it's not like they can keep doing this all the way up to March 2019. They've actually got 6 months, and that's it. At that period of time, there's going to be some serious consideration for what Europe has to say about the framework of the deal at that point. So I think unlikely after the May hike, this seems the most opportune time. This obviously coincides with the inflation, the quarterly report, and then that's probably it for 2018, I would think. Going further on, this is kind of the progress check. Where are we up to with talks? Well, the first 2 points have definitely been ticked. That being the divorce cost. You've probably seen these numbers, that kind of 35, 39 billion figure. That was kind of the first thing that got discussed. If you remember, it started at David Davis saying we'll pay 1 billion. Europe said 100. Then it went to 20 to 60, and they've kind of settled on around 40 at the moment on the initial divorce fee. The transitional period obviously has been secured. The other things, though, that are more, let's say the negotiations haven't really started yet, because all we've done is said, okay, this is the fee we'll pay and we've got time to talk further. The actual Brexit deal, so the outlining of the trade agreement, that really hasn't even begun yet. And as you can see here, marked by this kind of barometer, it's very early days. The other big one, of course, the Irish border. Both sides have agreed a need for a backstop option should the overall Brexit deal fail to avoid a hard border, but negotiations are no closer to reaching an optimal solution as yet. So, still quite a few things to get through. Other charts here explaining some other interesting things. I thought this was quite interesting. And again, Sam's going to like this one, because it really shows that Europe needs the UK a lot going further forward into the future. And the reason that I say this is that high birth rates mean that the UK's population is growing way quicker than actually most of mainland European countries. The EU estimates that the UK will be the most populous nation in Western Europe within 30 years, with also one of the youngest populations who are working. Now that means the UK will be less impacted by the cost of an ageing population. So things like pension, healthcare costs, things of that nature. So in that respect, you're going to have a very active, young, dynamic workforce with the capability to spend. So you want to be tied, if you're Europe, to the UK market in that respect and a setup. But this is talking, we're looking at population projections all the way out for another 30 years down the line. But quite an interesting concept here, meaning that the UK in the long term is an increasingly attractive market to export goods to. So it's not just it's not just complainer remainers like me. There is means to say that in long term, if you could get over the short term pain, there is potentially long term gain in this respect. This was just quite interesting. And again, this is really when it gets to the crux of the legality of the trade talks, which, as I said, hasn't really begun. What was quite interesting, a statistic, a download of US simple spreadsheet offering a fairly broad summary of all the tariffs that would need to be worked through. Just to give you an idea, it's 20,000 lines long. And just to give you a bit of a flavour, this is just a little snapshot of the tariffs around woven fabrics. And you can see here, even for just that section, there's different tariff scales depending on if you've got woven fabrics with man-made filament dyed, or cotton yarn of different colours, or cotton printed. All comes with different tariff rates. So it's incredibly complex, and how they're going to do this in the time frame is going to be one of the biggest challenges, I think, because this is just one thing there's a good few other several thousand that they've got to legally agree on. The other thing, of course, is that this legal agreement is really key, because dispute resolution on these legalities takes, on average, several months just to resolve 1 point, never mind several thousand. So again, it makes it a fairly difficult task, you would think. Final few things. Again, this is quite an interesting graphic, just looking at the Irish border. Can it be avoided? I thought this was quite a different idea, I guess, because they've talked about, and you've heard the Tory government talk about technology, i.e. pre-custom notifications in order to maintain a softer border. They've talked about custom partnerships as well. But one thing ING have noted is, could they use blockchain technology as the answer to the Irish border issue? Talking about distributed ledger technology allowing real-time tracking of goods through the supply chain, reducing the need for paperwork. The reason why that's interesting is because if I go here, this is a study as to the complexity of the movement of goods coming out of our country. And you may have heard me talk about this a few weeks ago, but from a logistical point of view, Dover is obviously the biggest hub, if you like, of traffic of UK ports, obviously going off to mainly Europe. At Dover, less than 1% of lorries arriving and departing currently require checks. But a study that's been done says that adding even 2 minutes to those checks, if that was going to happen, going forward, could generate queues of up to 29 miles long every day on the M20 motorway. Not only that, David Davis has talked about obviously hiring multiple thousands new staff to man these new ports, but to train those staff takes approximately 3 years on average. If it was Germany and 2 years in France. So don't forget, the transitional period elapses in 21 months. So there's a lot to be done in that period. The other thing, of course, is the political situation. And this is looking at something we had in the FT a few weeks ago, but it's the Prime Minister Theresa May's big test. And what's going to be coming up soon in the months ahead is an amendment committing the UK or not to remain in the customs union. And the reason why this is important is because at the moment, on keeping the UK in the customs union, which has obviously been the Labour stance, the opposite has been that always of the Conservatives since the referendum itself, is that the MPs in Parliament are split right down the middle equally at 321 MPs each. So obviously there's 10 more Remain-minded Conservatives, but likewise there's 4 Labour members who want to exit. But net, this is equal, and a defeat would be a major blow to Theresa May's leadership when this does occur. On that point, though, it is worth noting that these are probably some of the headlines you've been reading in regards to UK political news in the last week or two. Labour Party in a meltdown over anti-Semitism. These are the headlines that have been run across all the major newspapers. Well, what has this really led to? Well, one thing is there was a new YouGov Times poll, and the Conservatives now lead the Labour Party by 4%. Last night's YouGov poll means that 75% of all polls in March have recorded Conservatives leading, making it the worst month in polls for Jeremy Corbyn's party since the general election of 2017. So if you remember, only 3 months ago, Labour was ahead in nearly every poll. And now, just given this latest situation, it's the other way round. And obviously, Theresa May having some success in securing this transitional deal, which was a big risk, probably has helped sentiment as well, I would imagine, in that respect. So, yeah, have a look at this report. It's very interesting. They go on to also talk about their expectations and actual price levels in the foreign exchange market of where they see cable long term. You'll see here that ING are actually way more bullish than the market is expecting from an average basis. They're actually anticipating that cable in Q4 this year is going to rise to 153. Don't forget we're trading a 141 handle this morning, so they're way more bullish. on that expectation. All right, let's have a look at a few other things, because I want Sam to have a look at some of the charts with you guys as well. This is the story of the week, really, and this is technology volatility. Nasdaq 100 outpacing that of the kind of benchmark S&P 500. You can see this the volatility gauges for each respective index, and way higher in the case of the Nasdaq. Now, a couple of the things that we saw yesterday, and this was the heat map. There's obviously one here that's a real standout, and that's right dead center, Amazon. Now, they actually finished the session down about 4.4% yesterday, but Amazon were down, when I looked at it at one point, over 7%. They were down about 7.4 at the low, which equates to about $53 billion of market cap lost. And it came after those reports we were covering yesterday that Donald Trump was looking for ways to go after the company in terms of taxation, basically. So apparently the sources were suggesting a lot of his business friends had been saying that actual brick and mortar was being hurt in terms of more traditional retailers, which we've obviously seen there's been a behavioral shift to online purchases, and Amazon's really taken that by the scruff of the neck. But now Trump's said to be targeting, and apparently he's got Amazon is right at the top of his list of companies to go after. Another thing as well with technology, I did see an interesting quote from JP Morgan, their asset management head, who basically said we've moved from a significant overweight in technology stocks approximately 18 months ago to now being slightly underweight tech relative to benchmark. This was in part due to profit taking on the back of strong performance, as well as a less favourable outlook for earnings growth in companies such as component manufacturers in the smartphone product chain. So yeah, there is definitely a meaningful shift out of the most outperforming sectors that certainly were a key theme from 2017. Sam's going to talk about this a lot more coming up, so I just really wanted to just show you, because this was something we were looking at yesterday, which is the 200 DMA in the S&P. You know, the big question mark here is it going to hold again? And it has done on these, as you can see, 4 distinct occasions. And some analysis that I saw this morning was talking about, obviously we're coming into the end of the month. What does April look like as a tradable month for the S&P 500 average monthly returns? Well, April has been higher 9 out of the past 10 years when it comes to the S&P 500. As you can see by this chart, it's pretty much the 3rd best performing month on that statistical data set. Talking about the end of month, one thing I did want you to be aware of is month end and quarter end rebalancing. Now, I did see this morning. This was Barclays had put out a research note about month-end FX rebalancing, and the model that they have points to strong dollar buying against the euro, the pound, the Aussie and the CAD, with moderate buying signalled against the yen. Now, what exactly is rebalancing for some of the newer guys? Well, rebalancing, the process of realigning the weightings of a portfolio of assets. So rebalancing involving periodically buying and selling assets in a portfolio to maintain an original desired level of asset allocation. Now, if you think about the dollar, this is the dollar index year to date. Now, one thing that's been absolutely clear is, although the dollar has picked up the last couple of days, which is likely part of this rebalancing process, the dollar has been absolutely slammed since the beginning of the year. If you look at it, the dollar is down heavily. So if you think that we're coming to month and quarter end, hence the reason why now, if you're rebalancing, you're coming out of those dollar shorts, which have really earned you good money over the course of the last 3 months, and you're rebalancing back to your original allocation levels. And that likely means then buying back some of the dollar against these other currencies as you unwind some of those trades. So again, it's a function of the seasonality, if you like, in the calendar. So something to be aware of, and something definitely we saw yesterday. The dollar was on fire yesterday, and it wasn't like we had any new news in that respect on the trade war stuff, Likelihood a lot of this as well being exacerbated by the fact that volumes are generally lower, school holidays, and obviously in the run into Easter with the market closures globally tomorrow. Okay, finally a look at the calendar. We've already had a couple of the German state CPIs. German state of Saxony, no real shocks, month-on-month 0.4%, so remaining static for inflationary conditions. We'll look out for the others to come out momentarily. You've got German unemployment data, not so much of a focus, I'd say, for European assets. So not looking for too much reaction here. Later on, again, GDP data, but final. And these are Q4 numbers for the UK, so of little consequence really. Expecting them to be unrevised. Going further forward into the afternoon, things might get a bit more interesting. I would say economic data has taken a bit of a backseat. If you think about when are we expecting the next interest rate hike from the Fed, well, that's going to come in June. So economic data coming out measuring the month of February is quite a fair distance. And at the moment, the market has been more focused on things like trade war rhetoric from the US and also this weakness, whether it will continue or not for the technology sector. And then key technical levels like this 200 DMA in the S&P, I would say, are probably more of a focal point for the trading day ahead rather than so much data. Probably the one thing I would keep an eye on is the 130 numbers. Core PCE obviously starts to be tied into inflationary conditions and historically one of the more favoured indicators of the Fed that they'll look at. Okay, I'm going to hand you over to Sam. So if I don't speak to you beforehand, have a great Easter. Thank you very much.
Yeah, hi guys. Just going to have a quick look over the currencies to start, and you can see euro dollar actually just coming back down to where its low was there yesterday and this morning, having broken through a bit there. So yesterday's low acting as a bit of support early hours, and then we're just having a bit of a breakthrough in terms of levels to the upside, possible points of resistance. I'll be looking around this sort of level support that we then broke through. Let me just get this rectangle up, anywhere around here, and then you had a bit of a breakthrough from these levels, and then obviously this sort of double top that you've got here, 123.85 and a half there on the futures. If we were to continue to push down, and which has really been the trend of the last few, you can see just how important the low that we previously made on the 22nd. You might not be able to see that because of my camera, so I'm just gonna bring that into a picture a bit there. You can see the first real test of that has offered very good support, as you'd sort of expect from that first test. So I'll be keeping an eye on that. The low of the 22nd, which is pretty much the low of today to the tick. A breakthrough there, a clean breakthrough there, and S1 today is pretty much bang in line with the low that we made on the afternoon of the 21st, and the low of the 20th just a bit below that. So key levels there to the downside. You can see the high of the day marked up here. Let's just go back to that 60-minute time frame. You can see how well that has acted as resistance to date, once as support yesterday before we then broke through. So it's acted quite technically over the last couple of last few hours, I should say, sort of stuck within that range. I think you've got to favour the downside today for the dollar pairs, really continuing the sort of trend that we're seeing into the end of the month and quarter. So just bear in mind that I think in terms of looking for sentiment to really change to the upside, I think this sort of level halfway in the day's range could be key, but perhaps safer really you'll be looking maybe at the pivot really breaking, or let's just see if we can get any sort of trend on here. Okay, that's quite an interesting one that I just had a look at there. You can see once, twice, 3 times. So really if you get a break out of here, then sentiment could be looking to change to the upside, but I think favouring the downside could be the better option to go for. Having a look at the pound, similar sort of story in that we have just broken through today's low. S1 sort of first test of that, holding up quite well, and we just move that. You've got pretty much bang in line the low from the 21st of April, similar to euro there. If we were to get a break, let me just move that out of the way of the camera. If we get a breakthrough here, then it does open the door to the levels of support that we did see on the early hours of the 21st, but perhaps a cleaner level, and is a very important one, higher the 16th, which was the low of the 20th. One to bear in mind if we do get a bit of a sell-off that we saw yesterday. These levels wouldn't seem a million miles away. In terms of the upside, so looking for where sentiment perhaps could change, you've got a trend line that you would want to have going from yesterday's high. Let's have a look at that around there. 1, 2, 3 tests, so it's been respected quite well for now. In terms of key resistance to the upside from a market level today, you've got the previous sort of a level of support that we got around 5 a.m. Haven't really, I suppose we did have kind of a test of that later on, so I'd probably say you want to get a break of sort of 141.19 to the upside, and then really obviously safer would be looking at the high of the day and these levels that we broke through yesterday afternoon. Break of that, then yeah, sentiment can start changing. I think even then though, the pivot looks quite good. You've got the pullback that we saw yesterday afternoon pretty much bang in line with that today, and then going on, if we were to get there, you've got the break of the morning low as well to have on. And you can see yesterday was a pretty decent opportunity as we did push lower there, this break of this charting pattern, and it really did continue to the downside. Again, same with euro, favouring the downside there. $1 pair that wasn't making a new low at the time. You've got Aussie dollar here, and we actually have early hours of this morning pushed lower. Bit of a trend break, as you see there. So last sort of 2 trading days really trending down quite nicely, and we've had a decent break of that level to the upside. In terms of decent resistance, if we were to continue to push on, you can see how choppy it has been around this pivot. I'd almost disregard that now. We've got all these resistance points from yesterday that you'd want to bear in mind. R1 for me looks like a good level to get short to continue the overall trend, but just bear in mind we have broken this 2-day downtrend to the upside here, and although I would really now be looking to sort of leave pivot alone there. Dollar yen, to wrap up the currencies, you can see having broken through the highs, I guess we'll call that a double top from the 20th and 22nd. Nice little breakthrough yesterday, came back, found support on the pivot, which was, I mean, it didn't quite get to yesterday's original high, but good level of support there for perhaps a push on, and really a sort of a break from those levels. So I'd again prefer this market to push higher, with the dollar strengthening perhaps into the end of the month. But just bear in mind, what happens with equities can of course swing this market one way or another. And there was a couple of times yesterday when it was quite confused what was going on, in what direction to go. And you can see around here the cash open sort of time, it was very, very sideways. So perhaps looking for a strong or weak dollar move to favour euro or pound against the dollar there. Having a quick look over at US equities, I'm just going to clear this chart up and just remove all of that, put it on the daily and get the moving average up. And as we've been talking about over the last sort of couple of weeks, just how important that 200-day moving average has been, offering very good support here and there. That sort of double test, and sort of going back really the last sort of 2 times we were briefly below middle of November, Trump, and then that infamous day back in June 2016 for Brexit. And you can see as soon as it goes below, pop back higher and not to be sort of seen again. And look at the direction I was moving this to the right now. It's just been slowly grinding higher and higher until now. I think if we do get a break, and today will be from definitely a technical point of view, where the sort of the week closes, where the quarter closes, where the month closes. Even if we do get a push below, it could be a decent opportunity perhaps to look to buy. You've got April 9 out of 10 times as higher. So let's see. I think even if we do get a break lower, could be a half decent opportunity to look for an extension, back to higher levels. Let's have a look at the Nasdaq. The 200-day moving average, haven't quite tested it, so one to keep in mind if we do get a continued sell-off in tech there. Dow Jones again hasn't really come back to sort of test it. One market that did break through, and obviously quite a while ago, was the DAX there, and not that we're anywhere near finding resistance to the upside, but you can see as we did break through, it did come back and find strong resistance there. So it might be something later on in the year perhaps that we look to come back and retest it. And just bear in mind how how good a resistance level that had been following the breakthrough in the early stages of February. Have a quick look at gold. Bring this back onto a 60-minute chart. I'm just going to put the pivots back on before we go through oil. Pivots on 6 minutes, that's why. Before we have a look at oil, just to wrap up. So gold with this dollar strengthening has been pushing down as well. Just similar with euro and pound, making that new low briefly. In terms of technical levels to the downside, a really sort of strong area I would be looking to consider was the high of the 19th, and having broken through a couple of trading days later, the low of the 21st, 1324. There you go, marking up there. Can you see that? Because let me just move that out of the way. There you go. Pretty strong level to be aware of to the downside, and even then, if we do just have a little pop, decent perhaps area you could consider for the stop, the previous high, that 21st, before we did break through a few hours later. But one to bear in mind, if the dollar is strengthening, then obviously it may be that you're looking for this area as a whole to sort of break down. And I'll be keeping an eye on the dollar index, which has had a couple of goes at testing that high already this morning that we made yesterday, so just bear that in mind as well. And a quick look over here at oil, which pushed higher on the release at 3:30, and what a strong level this area had been. 65, let's just call it 65.14. You had the sort of the lows on the 26th, the lows on the 27th before we broke down. Also the pivot around there yesterday. Price pushed higher, and to be honest, it hung around there for about 5 minutes. A really good opportunity for anyone that was long to take profit, or if you were brave enough to want to take that short on. Technically it is a great level. Price came all the way back down before bouncing into the sort of the latter stages. I wouldn't really want to get involved in oil unless we do sort of break out of this mini range that we're in. I guess to the upside you've got it there is 64, in the mid 80s, 64.86, and to the low 64.5 dollars there. Really a breakout of that sort of range could be the opportunity. Again, thinking about the strength of the dollar, how this could impact oil as well, either way, going into the end of the month and quarter. So I would say for now favouring euro and pound to the downside. Our equities, I think best to wait until the sort of the afternoon to get a general feel of that market. But even if we do get a break of that 200-day moving average in the S&P, just be half careful. I think there's definitely going to be stops below there. It could get quite messy. If we were, definitely one to have on a chart just to the side. Obviously you have your 16, 15-minute charts or whatever, but the daily one, definitely one to take into account. Data wise, obviously we've got a bit out at 9:30, the final GDP readings out of the UK, so perhaps best to sort of stay away from the pound until then. But yeah, any questions as usual, please get them in the chat. I'll be posting a couple of sort of month end charts going into sort of the afternoon, and we'll do a bit of a talk before the final cash open of the quarter. But yep, if I don't speak to you, same as Anthony said, I hope you all have a good Easter and a good rest of the trading day.